All right. Welcome back to another episode of the Hustle Harder Show. As always, your host, James Gaskin, and excited to be here with you. We've got an awesome guest today and really excited. Marcus and I have been talking about doing this for a while, and we finally were able to get it scheduled with both of our hectic travel itineraries. So without further ado, I want to introduce our guest today, Marcus Crigler. Marcus, welcome.
Hey, James. I'm glad we're able to do this. Finally, we talk about this every time we see each other, right? We see each other probably around once a quarter, and we're always like, hey, we got to get this podcast going so that we can have these conversations recorded. But, how was your golf round, right? That's usually how the conversation goes.
That's right. But, we put it together, and I think it'll be well worth the wait. So just to set the table a little bit, and then Marcus, I'd love to kick it to you to talk, a little bit about who you are, a little bit of your background, and then what you do. But, Marcus is I think the right characterization would be fractional CFO. Would that be right?
That's right. Yeah.
Yeah. So fractional CFO, and your business is entirely focused on real estate investors. So, Marcus brings a lot of experience working with, within the niche of real estate investors. And I think that's a really, really important point because, obviously, accounting, the finance side of business in general is a big world. But specifically, you have been working with investors to solve their unique problems for quite a while now. So, tell us a little bit about, you and your background. And, I think it's always interesting to hear kind of how you got into this and then some of the things that you focus on when you're working with your investor clients.
Yeah, totally. So I'll start with today, and then we can maybe go back to the very beginning of where it all started. So I own a Beck CFO and CPA, where we are a CPA and CFO firm working with real estate entrepreneurs across the country. So very simply put, we help people make money, save money, and build wealth in real estate. And then we do that through our kind of lens of accounting and finance knowledge, focused specifically on the real estate niche, right? And so that's kind of where we've developed to, but that wasn't where we started, right? I really got into this industry really because of my father-in-law. My father-in-law got me into this industry in 2008, 2009. We all know, if we're in real estate, what type of world we were living in during that point in time. And I saw so many people that were struggling financially. But my father-in-law, I'm not saying he wasn't worried, but he was good and he felt very confident in the money that he was earning. And I looked at what his career was, and he was an accountant. And if you know me, if you get to know me, you'll probably think, well, Marcus, you're probably the farthest thing away from a CPA or an accountant. But that was the path I chose and fell in love with it, right? Fell in love with accounting, fell in love with being able to utilize numbers to help people's life, really. And that's really what accounting is all about. Is a lot of people think about it as bookkeeping or, fractional CFO or even tax savings. But at the end of the day, what it all comes back down to is simplifying somebody's life. And so what we do, and what I've kind of learned since that time, is we've got into this industry, and there's several iterations of it. I was with another CPA firm that was a great experience, and bought out of that CPA firm, and then opened this one in the middle of COVID, but learned very quickly that if we were going to truly add value to the market, we were going to have to specify, and we were going to have to be truly focused on one area. And I just happened to be in that area of real estate already, and I was falling in love with it, right? I fell in love with the actions of real estate entrepreneurs. It's a combination of two very, very different skill sets that come together to make one really interesting entrepreneur, right? You've got the entrepreneur skill set, which you see all the time out there: sales, marketing, the ability to generate revenue. But then you've got this investor skill set of buying and holding properties and flipping them and adding value to those properties, so they go from being worth 200 to worth 400, right? And all these cool things. So I fell in love with that. And since then, it's been writing this business, right? Beck CFO and CPA, and trying to help as many real estate entrepreneurs across the country get their numbers right so that they can make more money. And ultimately, when you make more money, you got to save money in taxes. So we do a lot of work behind that as well.
Awesome. No, that's a great background, and I think kind of lays it out perfectly for the things that we want to discuss here. I'm curious though, and you and I have never talked about this, but where did the name come from?
Yeah, so that's funny that you asked that. So I've got 3 kids, Bennett, Ella, Carter. That's my youngest to my oldest. So it actually came from the first letters in each one of their names. So when I started this company, I did not want to start it with my last name. You know, if you look at the traditional, a lot of the other CPA firms, which a lot of them have gotten away from this, but certainly when I bought it, it was, you know, Smith and Smith CPA firms or whatever, Johnson and Johnson CPA firms or whatever. And I didn't ever want the CPA firm to be about me. I always wanted the CPA firm to be about truly putting together a business that helps people. And I think when you start worried about whose name's on the front door, you start forgetting about who you're actually serving. And so that was a core focus of ours when we started this thing from the get-go. And now Beck's just Beck, right? And, you know, some people ask, some people don't, but it's just become, you know, just the name of the company at this point.
I've always known you to be a great family man, and I know that's a huge part of your life. And maybe we will touch on that a little bit more, but I think that's great. I did not know the answer to that. So it could have been anything, took a risk there, but that is a great story behind the name. I like it. I think a lot of people, number one, I think real estate investors, you know, and you know this well, you know, they tend to be, what I see anyway, is a lot of them are really good with, you know, the nuts and bolts of running a real estate business. They love working in the dirt, right? They love putting the boots on and getting on job sites and, you know, picking out materials and managing subs. And they may not love all that stuff, but it's definitely something that they are very proficient at if they get to the level where they're owning a business that is actually, you know, successful. They are not, in my experience, known as amazingly sophisticated financial people. And there are absolutely counter examples of that. But, you know, that does not tend to be one of the areas of strength that kind of gets you into this. Has that been your experience?
Yeah, well, absolutely. I think it's what keeps us busy, to be honest with you, which is, you know, it's a good and bad thing, right? You know, I think the interesting thing about real estate, and maybe it's different than most other industries, in that most of the people getting into real estate are first-time business owners. This is the first business that they've ever owned, or it's the first business that their family has ever owned, right? It's, you know, it's their first world of entrepreneurship. And a lot of that, I think, is due to the really the low barrier to entry to get into the industry overall. And so you've got a lot of what I would call rookie business owners, or business owners that, you know, I hate to say this in some ways, but have no business owning a business yet in their life, right? They haven't, you know, mastered some of the accountability and responsibility that it takes to run a business and run one effectively. But I think what you see is that once those people have a little bit of success and they start seeing that, okay, well, actually, this isn't just a way to make money, this is a way to build a business, they end up going back to finding out, well, hold on, a business has certain things and requirements of that business, right? And part of that is, hey, I've got to keep track of the money coming in and coming out. It's got to be more than just a bank account. It's got to have, you know, one of these things called a balance sheet, and one of these things called a P&L, or a profit and loss statement. And these are, you know, you got to have cash flow, and you've got to kind of understand when the cash is coming in and when it's going out, and the timing of those things. And for most business owners, I mean, even if you just listen to me say all that stuff, you're like, oh my gosh, this is exhausting. And so it's usually one of the things that they'll stick their head in the sand about, right? It's like, until I have to have it, I don't want to think about it. But the problem is, when you have to have it, is when it starts costing you money not to have it. And so that's when the bank is calling, or James is calling and saying, hey, I need your financial statements in order to make this loan. Or you've got your tax guy calling, hey, I need your financial statements to file your tax returns. Oh, wait, well, I only have a box of receipts. That doesn't work anymore when you start becoming a sophisticated business owner, and you're in it for more than just making money, but you're actually running a business here. And I'll tell you, people don't necessarily, it's not a line where they just cross over, right? And they're like, well, I started this and I was just flipping a property, and then all of a sudden it spiraled out of control and now I'm flipping 10. And all of a sudden it's more than just a side hustle. It's this enormous business that has millions of dollars at risk and millions of dollars at play at any given point in time. And so when you're not really tracking it, when you're not really keeping out ahead of it, eventually it will cost you. And I will use this cautionary tale for anybody that's listening to this and they don't have what we call books and records. And guys, if that sounds complicated, it's just like QuickBooks, right? We've all heard of what QuickBooks is. It's having your information inside of a little QuickBooks file and having each transaction that hits your bank account coded to what it actually needs to be. And that's all it is. But the difference between doing that and having that done consistently and not is potentially whether or not you'll make it or not in this industry, and in most industries. I remember Robert Herjavec, which most people know him famously from being a shark on Shark Tank, was doing an interview one time, and they were like, what is the most important thing about a business owner that a business owner should know? And he said, you've got to understand the language of business. And he said, the language of business is accounting. He said, if you don't understand that, you're going to struggle your entire career. And I think a lot of business owners in this industry, they get to that point where they're like, okay, I've got to learn the language of business here, because I'm making a lot, I'm moving a lot, but I'm not keeping a lot. And that's where the struggle starts to begin.
Yeah, and I think that's a great way to explain it. And I asked the question because I feel like a lot of investors, to your point, the barrier to entry is pretty low. And I think a lot of people get in it and they don't necessarily, many people get in, I'm sure, thinking I'm going to build this huge thing. But I think a lot of people get in it because they have proficiency in it, in the space. They've been doing something tangential. They've been a general contractor or worked for one and saw this opportunity and jumped in, started doing some deals, and then almost a victim of their own success, they grow this thing that they maybe weren't really intentionally working towards, but they get good, the opportunities present themselves, they keep building a little bit of a balance sheet, and now they can do more. And all of a sudden it goes from a one-man band, which may be a little bit easier. And this is a question I'd love to hear your thoughts on, but could be a little easier to manage financially, into a business. And now you have people that rely on you, that you've employed and that are a part of your team. And you really have to start thinking about how to make sure that this thing works, because it's no longer like, all right, well, if this doesn't work, I'm going to go back and be a GC again, or I'll go, whatever the alternative might be. You're now impacting the lives of a number of other people. And I think that progression can happen really quickly. I've certainly seen it on the lending side. Companies that started where the lending piece was a bit of a side hustle for them, man, turns out to be, a real business there. And then all of a sudden, they go from opportunistically lending out a few $1,000,000 to a real company that requires a lot more to keep it healthy. And I think real estate investors fall into a very similar trap. And it's actually probably even more so with them, because you can get started and do a couple projects a year and make a living, for your family, depending on where you live. But, that can spiral in a good way, but it creates a whole host of problems that you may not be trained to handle. I think the other thing is that real estate entrepreneurs, I think maybe entrepreneurs generally, but certainly real estate entrepreneurs, our borrowers they're out there, and I think a lot of times a real estate investor's job is just solving problems all day. And this is just another thing. And, typically there, the buck stops with them. So they are used to kind of like, all right, I gotta saddle up and I gotta fix this problem. And if you do that in something like this on the financial side, especially when it starts to come to taxes and these other things, if you don't really know what you're doing, you can get yourself in a lot of trouble. But I think a lot of entrepreneurs in this space tend to feel like, well, I solve all these other problems. This is one more thing I've got to take, right? And I think having somebody like a professional that really understands it and understands this kind of vertical niche like yourself, I think can be massively important. And at the end of the day, I think we as lenders and others, we want our clients to succeed. It's not about making loans, it's about helping people build a business. Can't do that if you're running behind on your taxes and you start to get into that whole slippery slope, right? So I think that to me makes what you do so valuable, because most of these companies are not big enough to have their own CFO. It's not financially viable for them at that earlier middle stage. If they're lucky and they become very successful, then yes, you've got budget for a CFO and you should absolutely do that. But, there's a lot of people that are not ready for that. So to take advantage of someone like you with a tremendous amount of expertise and who's also seeing these same problems from lots and lots of different clients, there's probably not a lot you haven't seen. I think that makes you an incredible value and an incredibly important to the long-term success of your clients. And so I wanted to really bring you on here to help, folks who are still in that I'm kind of going to deal with it myself mentality, to kind of consider the alternative, which is, bringing in a real professional like you to help them. So I think that's amazing. I don't know if you had any thoughts on that, but definitely don't
Yeah, I
want to
think
cut you off.
so. Typically, what we see is the evolution, if you will, is that somebody will figure out that they need help, but what they do, and just like anybody, right? Just like when people are coming in and they need a loan, okay, well, what's the best interest rates? What's the least amount of fees that I'm going to pay? What's the best deal I can get on a loan? And what they find is that they're going to go out into, our industry, and they're going to say, what bookkeeper can I find? What overseas VA that I can pay $4 an hour to that can do my bookkeeping. And there are industries where that works, and that can work out for you, and at least in for a period of time. But what I will tell you is real estate's not one of them. Real estate's one of those industries when you are buying, fixing and flipping, selling, refinancing, holding, wholesaling. You've got subject to, you've got lease options, you've got all of these different things going on, and all of them have different treatments, not only from a bookkeeping standpoint, but from a tax standpoint. And I think that's where we see a lot of people kind of get in trouble. So eventually they realize, hey, I need to do something. I need to do more than that VA. And on top of that, right, when you hire a VA or you hire somebody outsourced like that, you have to train them. Well, who in your business is the best trained to train an accountant or a bookkeeper in your business? Nobody, right? You don't have one yet. And so what we typically say is, if you aren't in a business model where you've not grown your business to where you can hire 2 full-time employees in your accounting department, and there's a lot of safe money guards by having 2 accounting people in your finance department or more, right? We can get into the weeds of this with segregation of duties and all this other stuff so that you're not getting stolen from. But ultimately, if you can't afford 2 full-time employees in your accounting department, somebody higher, somebody lower, then you need to outsource it. And you can outsource it to somebody like us. Well, I'm a little biased, of course, because I run the organization, but we run an organization that has all of the financial back office in one place, right? That's kind of how we designed it, where instead of having to go to a bookkeeper for one thing and a fractional CFO for another and a tax strategist for another and tax prep for another, we have it all in one house, and you have one team that kind of gives you that full back office finance support. And, that was by design, because we don't believe you should run a business without that full finance support. Now, does that mean you come into our office and you're only doing a few deals a year and you need a full fractional CFO for your business? No, you might grow into that. You might need that. And eventually, just like you're talking about, James, you might grow beyond that and need a full CFO. That's where we feel like we've had the most success. And we have that several times a year where we've got people, we call it kind of a bell curve, where they come in as they're on their way up the bell curve and as their business is growing and they need more and more of our services until there's a time where the cost versus benefit's not there and they need to go hire that internal staff. They need to go hire that CFO. They need to go hire that controller. But also now you've got a team that's helped you build up the back end finance of that business so that you're not just handing over a big mess to a controller or a bookkeeper or a CFO that you're hiring internally. You're handing over something that's really nice, really clean, and able to have somebody take it to the next level through bringing it in-house. So I think that's really where, we've established ourselves within the industry. And I think that's what you need as a real estate entrepreneur, and really any entrepreneur in general, is to find a firm that is small enough to give you the attention you need, but has the resources to grow with you as you grow your business. Because again, we're all in this business to grow. I don't think anybody is trying to, they might be trying to stabilize, but I think when they figure out that stabilization ends up meaning that you decline, they find out that growth is back on the table, right? And so at least minor growth year over year. So that's kind of our philosophy on it.
Yeah. Well, if you're not growing, you're dying.
For sure.
It's a term I hear and hear a lot and say a lot as well. But I think you also, obviously, if you're going to get to a certain size, you can't just do the shoebox full of receipts anymore. That's just not going to get you there. And you made the point a minute ago, which I'd love to just reiterate. Most of the time, I think when people figure out, oh my God, like I really need outside help, a lot of times that's because you're staring at a tax bill that you did not expect and maybe don't have the resources to accommodate because of the timing of some of these things. That is the last place you want to be. This is a problem you definitely want to get ahead of, because if you're behind, that probably means you are in a bit of trouble, and that trouble can compound, I think, really, really faster than a lot of people think. And you and I know one another through the real estate mastermind, Collective Genius, and some others, but that's kind of where you and I have really developed our relationship. And I have had countless conversations, and I'm not asking, you're asking, you're talking to people about specifically this stuff. I'm not doing that, and I'm still hearing people who are, by all accounts, from an outside perspective, look incredibly successful, but they're not taking home a lot of money, right? Because of they're not matching up some of these things. They're not optimizing their balance sheet to be able to go and get the best financing, and their taxes are a mess. And that really stunts growth. And of course, as we both know, it can be the death blow if you don't address it, right? So I think those are all amazing reasons why any investors who are listening to this who do not have specialized help in this area should consider it, right? And we'll give people your contact information at the end. So if folks have questions and want to reach out, they can do so. But I can't stress enough, how many times I've talked to people, and in terms of the deal flow that they're doing, the size of a team that they've built, that are struggling. And from the outside, it's hard to tell. They're wearing the nice clothes, driving the nice car. They got a lot of great things to brag about. But when it comes time to, look at the bank account, a lot of times those guys are disappointed, and it can really hamper their ability to leverage the momentum that they've developed into a bigger and better business. And the last thing you want to do is pause that momentum to have to rebuild things because, you didn't realize that you weren't putting enough away for taxes, or the mismatch in the timing of income and when things are going out. And, the last thing you want as a successful investor, and, you and I know these guys work incredibly hard to uncover the opportunities and execute those opportunities. Man, don't let that effort go to waste. that's a good, I think that's a great message to start with. So one thing I want to jump into here is, you know, some of the, how long has your firm been in existence?
Well, so we just celebrated 5 years. Before that, I was part of another firm that was a real estate specialist firm that I was with for, I don't know, 9 years, 8 years, something like that.
Yeah, so you've been doing this for a good bit of time. So you've seen a lot of things. And one thing I also meant to ask you a second ago, how big is your team?
40-ish, something like that.
That's a lot of resources for people to have access to.
Yeah, it's growing, right? I'd say 40-ish because we're always hiring new staff members, right? So it's always a fluctuating number.
Yeah, so it's not you and two or three guys in a WeWork, right? So this is a real thing. But in your experience over the last, call it 12 to 15 years, what are some of the themes that you've seen with real estate investors, some of the challenges that you see pretty frequently that you're able to help them with? And then, the second part of that question, is how are those things looking kind of as you have progressed and as time has gone on? And, are the things that you're talking to real estate investors about today, the same? Is it really just a continuation of those common themes, or are you seeing anything, kind of unique and different in today's environment? A lot of tax changes with the tax legislation that was passed earlier this year. There just seems like the environment in general, not even real estate, right, but just the general business environment has been changing. I'm just curious if you're seeing a different set of challenges today. And then, of course, would love to hear kind of what you're thinking about as we look forward into our cloudy crystal balls.
Sure. Yeah, I've got a lot of thoughts here on this. And so for the first thing is we talk about this pattern that I believe every entrepreneur goes through. And I think if you go through it in the right order and do it the right way, you can get, and again, we all go into this industry with some sort of framework of wanting some sort of freedom, right? That's the commonality of it. Legacy wealth, freedom, time freedom, whatever it is. But it all ends up back to, hey, I want to do what I want to do when I want to do it. And that's kind of why I got here doing it. And so, and I'm a firm believer, if you do it the right way, you only need a decade. You don't need to wait until you're 60 something years old to retire. You only need a decade, but you got to have a focused decade and go through these processes and these steps. And that steps first is number one, hustle. That hustle part of your life is the life that you're going to be in, but you're going to get out of, and you never want to go back to it. And this is one of the things that people experience over and over again. And my belief is you should only experience it once. And so we could probably think about a few clients right now that are back in the hustle stage after they've already grown a business and done the successful stuff and had the successful things, but yet they're back scratching and clawing just to make the next month's rent, right? And we've seen that happen, and we see it happen over and over again, and it's very common in the real estate industry. But that's what costs most people decades, right? Is that they end up back in that hustle phase. And so what we believe, there's certain things that get you out of the hustle phase. First thing is you got to actually run it like a business. You got to get all your I's dotted, T's crossed. You got to have your balance sheet, your P&L. You got to have all those things. You got to have 3 times personal expenses saved, right? So that's a true monetary thing. You got to actually have money saved. And then when you get to a spot where you're actually consistently making money, right? That's another piece of this puzzle. You have to consistently make money. You move to this spot where you're in the secure phase. And this is where most people don't spend enough time, right? And the ones that figure this out, they're the ones that generally make the most amount of money for the longest amount of time. But this secure phase in your business is where you're getting your business reserves up to the level that they need to be at, right? You got at least 3 times business expenses. If you're taking short-term debt with your flips, like we're talking about, like James lends so much on, we expect you to have 10% of liquidity with every dollar of debt that you get. So for every dollar of debt that you put on your balance sheet, I want you to have 10 cents of liquidity. Why? Because that secures up your business. I want you to be paying yourself as an owner consistently every single month. Now, I have a belief that you need to get to $20,000 a month, but you're not going to start there, right? But eventually your business needs to be able to pay $20,000 a month. And when you're in this secure phase and you allow yourself to sit here and allow your business to actually be profitable for the amount of time, not expand beyond your means, to only expand with your reserves, you got your debt reserves, you got your business reserves. Now the next phase is expansion. Right. And the expansion phase becomes very, very easy because you've got everything that you need. Right? You've got your business reserves, you've got your personal reserves, you've got a business that works. And what you do during the expansion phase, this is so simple. Most people miss it. They grow their revenue or they grow their expenses with revenue. That's the wrong way to do it. You grow your expenses with reserves. That is the math equation. The ones that figure that out, that, hey, I'm not going to hire this next person until my current expense ratio is allowing me to cash flow enough to put that money in the bank. Let's say you have to hire a $100,000 person. Great. Well, you need 3 times that in the bank before you hire them. 3 times, right? A monthly salary. So let's call it $10,000 a month just for simple math. You need $30,000 in the bank before you hire that person. How much weight does that take off your shoulder of being able to hire that person, put that person into play and allow them to train? Because we know it's at least 90 days anyways before they're going to be profitable for you, right? So then you get to the expansion phase, and that's where you're, again, growing your business, focusing on what you need to focus on in your business, reinvesting in your people, reinvesting in your systems, reinvesting in your staff, doing all those things. And then you get to the last stage, right? You've got your business where you want it. It's making you more money than you can truly spend, right? Because we're getting to this $20,000 a month. But once you get to $20,000 a month, guess what happens? You start making 30 and 40 and 50. We're going to live off the 20. That's the secret here, right? When you start living off the 20 and stay living off that 20, as you expand and you're making that 100 grand a month, you get to this next phase, which is investment. And that's what you're truly hoping for as a real estate entrepreneur, is you're trying to get to that invest stage where, hey, my life is secure. I've got a business that's working, but I know that I got in this industry for the investment side of it. And I want to be able to take advantage of that. And that's how you truly take advantage of it. And eventually you end up in this kind of hockey stick effect where, yes, it's slow, and then bang, you're taking off through the roof. And we've seen those happen, right? And we see those people that take off through the roof and they never end up back in the hustle phase. And what you'll see, and you'll start seeing this pattern now that we've talked about it, is a lot of people end up in the expand phase too fast. They didn't secure their business, which is why they end up in the hustle phase. So that ends up being kind of that rat race or that hamster wheel. They go hustle, expand, hustle, expand, hustle, expand. And then finally they figure out, all right, 2-3 decades later, let me secure things. Let me get the reserves. Let me get the stuff that I need to have in place and then expand. And now I've got a solid foundation to expand on. It's like building a house without putting down the foundation. You wouldn't do that. Otherwise the house isn't going to be there very long. But yet sometimes we build a business that way. And so that works, by the way, in any economy. It works today. It worked 10 years ago. It worked 50 years ago. That's just the process of how it works. But you asked me what's changed recently, right? Here's what I'll say changed recently. 2022, 2023 was a boom for real estate investors, right? No doubt, if you were in the industry, unless you just tried not to make money, you made good money, right? But I was on a call literally this week, having this conversation with somebody that we both know, somebody that we both highly respect. They had the same top line in 2026 or 2025 as 2024, yet they didn't lose. They made $2.5 million less profit in 2025 versus 2024. Same top line, profit diminished. And it was simply because they got bloated in 2022 and 2023. 2024, they had some good fortune. And then 2025, they got to a spot where they were so bloated and the market gave them so much that now when they have to earn it back, which we're in an earning market now, that's what I would call today's market, is like, you got to earn it if you're going to make money. The days of getting lucky are over. You're in an earn it market. And so they had people on their team that weren't earning the payroll that they had. And so they got too bloated. And so we looked at payroll costs was, 45% of their overall revenue. Got a problem. I know where the issue is. You bloated in payroll and they're not paying for themselves. And so, the market kind of hit some sins, allowed us to build maybe bigger than we should have built. And now what I felt in the latter part of 2024, certainly 2025, and I'm seeing a lot of good things in 2026 where people have realized, hey, we can't have these big businesses that are this bloated and this fat and have assistants of assistants of assistants. We need to have people that are here producing revenue and people that are helping them produce revenue, and that's about it. And that's as simple as the business gets. So I'm seeing a lot of people going back to the just blocking and tackling. I've never seen an area, and I know I'm talking a lot, but I've never seen a time period, at least that I've been doing it, where more owners are getting back involved in their businesses that they weren't involved in, right? Where they're stepping into the table and saying, whoa, hold on. What the heck is going on here? I haven't had my eye on the ball as much because, again, we're all human. Got expanded. Profits were great. Check distribution numbers were good. Everything's going good until the market's doesn't have that tailwind. It has headwinds. Now we got headwinds. The owners are like, whoa, what happened? Well, how did we get here? And then they start kind of looking into it and figuring out that, what was going on within their business are not the decisions that they would have made. And I think that's a scary place to be, especially when you've got headwinds.
Yeah, I think there's a lot of great stuff in there. I think by nature, human beings tend to, hey, when things are going great, you tend to project that things are like, this is now the baseline. And that has definitely never been the case in real estate, right? We know that real estate is cyclical. So you're going to have good times. You also must plan on the things getting worse. And then, you typically kind of have this up and down nature of it. And I think, when I was listening to some of the challenges that you commonly see, and I think you laid that out really well. I think one of the thing that comes to mind, the word that kept coming to my mind was, discipline, right? You need to have a plan, and you need to stick to that plan using discipline. And, again, real estate investors by nature tend to be fairly risk tolerant, and that might be putting it mildly, right? These are folks that are hustlers, and I love that you kept dropping the word hustle, because it's in the name of the podcast, and that's really a thing that we think about a lot at Renovo, but I think it really applies to this whole industry. Is these folks that are out there, they are hustling, and they tend to be pretty risk tolerant. And so, it's very easy, I think, to overplay that hand and put yourself in a jam when things don't turn out to be, as good tomorrow or next year as they are maybe right now. And so it makes sense to me that you're seeing a lot more people kind of going back to the basics, because it can be, I think, very easy to let that slide. And of course, when you're having success and you're hiring people, that all feels really good, right? There's an ego component to that, but there's also like, hey, this is what I wanted to build a team. I wanted to help people improve their lives and help them build careers. You end up hiring people, and then times change. It's very difficult sometimes to right size the business because you've got the human element involved as well. So having someone like yourself there to kind of be that sounding board to say, totally understand where you're coming from, but if you want this thing to work and be healthy and survive for the rest of your team, you're going to have to you have to consider some difficult choices. but it's going to be for the best in the long run in terms of the viability and sustainability of your business. And I think it's really important to have that voice. A lot of entrepreneurs will pick a partner that kind of complements their strengths and weaknesses, right? You tend to see the visionary kind of maverick CEO, and then having a counterparty that is high in the organization that can really balance that risk-taking appetite with some grounded reality. But a lot of times folks are getting into this industry and they're maybe coming at it as a solo, and they don't have that. And I think, someone like yourself can kind of be that as an outsourced option that can really help you stay on track, which I think is super, super important. How are you thinking about, the coming 12 to 24 months? I feel like we've been in a fairly, I mean, the markets, by and large, I mean, you look at the country as a whole, real estate market's functioning very well. I wouldn't say, it's not, as you put it, right? I think you called it an earn it market. So you got to get out there and work and earn it. It's no longer falling in your lap, and margins are getting squeezed from all directions. So it is definitely a lot more friction today, but the market's still working. There's still a lot of opportunity, but you need to be financially prepared for it. Are you expecting this market to, and I know you don't have a crystal ball, but do you see that, kind of where we are today with a little bit of these additional friction factors persisting for a while? And if you don't have an opinion on this, totally get it. But like, I'm curious because you see all these businesses, kind of in the raw, if you will. How are you thinking about the next couple of years?
There's a lot of different ways I can take this question. I think it really comes back down to, I mean, honestly, if you're a real estate entrepreneur, you should be thrilled about the market right now. And the ones that aren't thrilled about the market are the ones that probably shouldn't be thrilled. They should be scared of the market. And that means you're likely not putting out a great product. You're probably not doing the things that you need to be doing to run a successful real estate business. But if you're one of those people that you're good at what you do and you run a successful business, then there's plenty of revenue to be generated. This market is not a market where, we saw in 2008 and 2009, you couldn't buy something and sell it the next day without it just tanking again, right? It's just not, that's not the market we're in. We've got some stability in most markets. We've got predictability in a lot of markets of what the price will be, which is what you actually really want. And quite honestly, you're in a market where the best ones are going to thrive, the worst ones are going to get pushed out. And, you need to be focused on being one of the best ones. And I think the world or the universe or God, whatever you want to call it, that it rewards the prepared, right? And so if you spent the last couple years not sitting in a hot tub of cash and buying Lamborghinis and Ferraris and hoping that this world would always stay the same, and you kind of put some chestnuts away and you got your business secured up. And even if you struggled, even if your business isn't, like, I've talked to several businesses where they're right sizing their business right now, but they're still excited for 2026 because they know how to run the business. They just have bloat in the business. And once you solve the bloat problem, which is a painful heart thing, like, just like you said, it pains me to get rid of this vendor. It pains me to get rid of this human, because there's this human element in small businesses that corporations don't really have to feel or don't feel as much. We feel that. And so we're usually late to the party of letting those things go. And so what we're seeing and what I believe is, if you're right sizing your business and you do a good job in this in the industry, I don't see that the market's going to go against you. Aside from a black swan event, we end up in some sort of World War III, or AI bots are knocking out our door, kicking us out of our houses. I don't know about any of that stuff, but certainly if we're kicking and screaming in the market that we're in, I think you should be excited. I think you should be ready to be better than your competition, because there is competition out there that's making money. I see it every single day. And if you're struggling to make money right now, it's not the market. That's a blame game. Get yourself, look in the mirror and say, hey, what do I need to do better? Do I need to get better at negotiating better deals? Do I need to get better at having better contractors? Do I need to upgrade my properties? Do I need to put better, fixtures in them for them to sell better, faster? Do I need to stage them? What are the things that you need to do better so that you're actually the guy to compete with, or the girl to compete with in the market, versus being the one that's trying to catch the person that is the leader in the market? And I think that's the key right now. There's no crystal ball that's gonna, up or down. I don't think that matters. I think it's just focusing on being better in what you do.
I did an episode that we released last week, so it'll probably be 2 weeks from when this comes out, but talking about kind of what I'm seeing in the market and kind of how I'm looking at the future, and it's very similar. I mean, I think my comments around that are, I think this is a time to really sharpen your pencil. You gotta be good. They're over, you mentioned 22, 23 being amazing years. A lot of people got in without a lot of experience. They did very well. This market is likely to shake out some of the pretenders, right? And I think the people that are not really like attacking their business and like really paying close attention. I mean, I think that's probably why you see folks who had, at CG, we like to say they had moved to the owner's box, right? They were the business. They grew a team. They have a trustworthy team that they believe in. They entrusted the business to their team, and they kind of took a step back out of the day-to-day. And all of a sudden it's like, whoa, what is happening? What are you guys doing to my business? And, now they're having to jump back in and fix a lot of things. This is the kind of market that necessitates that additional level of scrutiny and that discipline to really make sure you're running a tight ship, that you don't have waste in the business. And quite frankly, really, I think being very, taking a critical eye to the strategy, right? I mean, I know a lot of investors who, have been operating a certain strategy. They've been hitting, buying property that they are going to sell kind of in a certain price band that was, really, for lack of a better word, easy for a long time. Some of those segments in certain geographic markets are not doing nearly as well. Counter to what I think a lot of just, random people on the street would think, some of the lower price product is actually struggling the most. And, a lot of people go, how could that be? We need more affordable housing. How are the lower price properties not selling as much or as well? Interest rates, people at that level are heavily dependent on interest rates. People at that level probably don't have a huge stock portfolio that they can lean on if they need to, right? And there's a tremendous amount of competition. And, home buyers, I think right now are able to be pretty selective. I keep hearing it over and over in different conversations. Home buyers, especially at the lower end, are not in a huge hurry. They think rates might come down. Great, not as much pressure. In some markets, there's a lot of inventory in these lower price points that is allowing buyers to take their time because they're not concerned about, when I bought my house, and I do live in Austin, Texas, which is the poster child for, a little bit of this most recent real estate bubble, if you will. But, when I bought this house, I was putting in offers significantly over asking and getting laughed at, on other homes, right? I mean, the competition for homes in general was incredibly stiff. That's not the case. And so a lot of people who have had that strategy that's been rinse and repeat, and they've been just milking it. If you're still doing that stuff and you're not asking those difficult questions about, is this the right strategy? Is this helping me accomplish some of these financial goals that I need for the health of my business? I think you're doing it wrong. And I've heard a lot of people moving to a little bit higher price point because, there's those homes are moving faster. And if you're putting out a good product, you're probably able to sell pretty quickly, and you're taking a little bit less risk up front in terms of, the exit. There's other considerations, right? I mean, I'm oversimplifying, but I think this is a really good time to be doing those kinds of things. And I think that's kind of what I'm hearing from you.
Yeah, no, you're exactly right. It's interesting. I always go back to a presentation. It's probably 2018, 2019 at Collective Genius. And this gentleman, I don't remember his name, or I would give him his due, but he was talking about the difference from taking a property to be there's only so much you can do with a property, but taking a property and adding some of those minimum upgrades that really don't cost you much, but also sell the property significantly more. And I just remember this story. He talked about, well, one of the things we actually do is we take out one of our lower cabinet areas out. That's usually cost us $250 for that cabinet piece. And we actually replace it with a $150 wine fridge. And that $150 wine fridge saves us money, and it looks higher end, and the house sells faster because guess what? Mama has her own wine fridge in her newly built out kitchen, and nobody else has that wine fridge. And so I always talk about that story when we're in times like this. What's the wine fridge? Right? What's that upgrade that you can make your house look a little bit nicer, and you find out, whoa, hold on, that's actually even cheaper for me to do it that way. And yet the buyer, the end consumer, is the one that, they love it. And so, again, it goes back to, and maybe it should have always been, but what does your consumer want? All right. What is it? Who's out there? What are they buying? What are they looking at? What do they need? Who's got the money? Right? That's kind of what you're saying. Hey, the people that have the most amount of money, they still have money, right? They're still buying nice houses. They're still buying nice things. A couple $100 a month in a mortgage payment isn't the difference from whether they can afford the house or not, right? Like that's not, but at a smaller house, right, a lower priced house, that couple $100 is the difference between whether they're going to get groceries or not for the week, right? And so it's just a massive difference. And I think that's an interesting strategy. And we've seen that too. I was talking to a gentleman out of South Carolina, and that's exactly what he was saying. He's a real estate broker actually, and he's like, hey, if it's above like the $750,000 price point, it's off the market. It's sold. It's getting out of there pretty quickly. If it's below 350, it's sitting there waiting. And it's hard to really distinguish those properties because there's a lot of them. There's a lot of them on the market. And, interest rates just are not down low enough to affect the payments to incentivize those buyers into those numbers. So it is interesting, but I like what you said there. And I think that's a really smart thing to be thinking about, is just how do you make your property different, and how do you focus on the end buyer? And as long as you do that, focus on the customer, your customers are end buyer, you should be good, right? Don't overcomplicate it. Focus on what your end buyer wants, and you'll have a buyer.
Yeah, I think that's right. I mean, I like the term, be a student of the game, right? And if you're always kind of looking at it from an academic standpoint, like, sounds simple, but shop your competition, go to open houses. What is everybody else doing? What's the house down the block doing? How can I differentiate? And then I think you said something really smart about knowing your buyer, like really studying your buyer. What are the challenges? What helps unlock value? And I do think you've got a lot of people on the lower end, that are looking at these lower priced properties, maybe a first time home buyer, that, rates remain elevated. I don't, yes, I think we're going to see some more Fed rate cuts. Depending on what else happens in the world, that may or may not really impact the ultimate, mortgage rate that the buyer is paying. But what are those levels that unlock affordability for, this subset of people. And if that's the market that you're going after, you're going to have to get creative. And I think that only comes when you're taking a critical look at all of these inputs and variables. If you're just on autopilot, you are likely to miss these things. And then you, like, to your point from earlier, you notice them when it starts hitting the bottom line. And your hold times are longer, so your debt costs are up. You're having to lower pricing to attract a buyer, and it all crushes your margin. And then before you know it, you did a whole lot of work and you don't have a whole lot of money in the bank to show for it, right? Let's circle back a little bit to some of the financial stuff. Obviously, your expertise. You mentioned a couple of ratios there at the beginning. I'm curious, what are some of the main financial ratios that you look for when you're trying to assess the health of a business? I'm sure some of them will be pretty obvious that most people have heard of. There may be some others that are not. And I think you mentioned you're going to hire somebody, you need 3 times their monthly salary in reserve, to cover that overhead until they start, generating enough revenue to pay for themselves. That one I thought was super interesting. Do you have, what are the other kind of ratios that you kind of keep a close eye on?
Let's start on the P&L, right? And so let's first go back. If you're a business owner right now, you really shouldn't be diving into P&Ls unless you find an issue with your ratios. You should start with ratios and then go into your P&L. Your ratios are like the 30,000 foot view, right? It's like your dashboard in your car. Okay, I'm not checking my oil unless we're at 3,000 to 5,000 miles of driven, or if something's blinking and says, "Hey, check your oil," right? Like, well, that's kind of what we want to run our business off of. And so it's important to have KPIs. And a lot of people, say that terminology, KPIs, ratios, dashboards, those are all sexy terms. But at the end of the day, what you're looking for is an alert that says, hey, this business is running off track. We need to do some sort of adjustment, dig into this alert and make a decision. Right. And so a couple things that we look at on the P&L. First off, for real estate entrepreneurs, we do not look at revenue. We look at gross profit. Okay. So if you're flipping properties, right, that's going to be your net profit from the flip. Right. So you bought a house, you rehabbed it, you had holding costs, you had, financing costs, and then you profited from that. There's a whole calculation and a gross margin calculation that we want to kind of keep an eye on. But for these specific formulas, I would just want you to stick with me with gross profit. And so when we look at gross profit, which is kind of our top line on a P&L, underneath that, there's 3 distinct expense categories. And this is generally for any business. There's advertising and marketing, there's human capital, and then there's general and administrative. Everything falls into one of those 3 buckets. And if you're a real estate entrepreneur, if you're a business owner, what you want, at least at a minimum from your P&L, is to know what your ratio for each one of those expense accounts are to gross profit. So for instance, if human capital is 30% of gross profit, that means you spent 30% of your income on payroll, on people cost, on benefits, on all those things. If 30% of your costs went to advertising, that was 30% of your expenses went to generating the revenue that was up there. And so what we do is we kind of set, hey, what are those percentages? Should it be 30? Should it be 40? Should it be 20? Should it be 10? And that's how you're basing your numbers off of, hey, wait a minute. I expect human capital to be 30%. It's 45%. Alert, alert, alert. Let's dive in and figure out what happened. Could be a million different things that don't matter, right? A lot, and just like in life, when we're driving down the road and some sort of flash on your car says, hey, you need to check something. You go to the guy, he runs something. He's like, I just cleared it. It's good to go, right? That happens in business too. I looked at it. Oh, we paid out bonuses to a couple key team members. That's why it was up for the month. No big deal, right? And so we like to say, and a lot of real estate entrepreneur businesses are different, but here's some simple numbers. If you spend 30% on advertising, finding your deals, 30% on your people to service your deals, and 10% on G&A, everything else, that's how you run a 30 margin business, a 30% net profit margin business, which is what we believe a good, healthy real estate business looks like, right? And so you can adjust that, right? Maybe your marketing is 25 and your human capital is 35, right? But you can kind of play with those ratios a little bit to get you where you need to be. But that's where we start with. And then we look at the balance sheet. There's a couple ratios I look at the balance sheet. The first one's going to be the current ratio. This is probably one of your favorite ratios that we look at because we're looking at how much current debt that you owe against the amount of current assets that you have. And do you have enough assets to pay for the debt that you actually owe, right? And so that's critically important. If you look at your balance sheet and you've got, let's say, $1 million worth of assets on your balance sheet, but you've got $1.2 million worth of debt coming up due on your balance sheet, we got a problem. Alert, alert, alert. We need to solve it. I don't know what we got to do yet. We'll figure that out, but we got that alert that's coming in to solve that problem. And then the last one is going to be working capital, right? And so that's going to be another balance sheet one that's going to tell you similar formula, current assets minus current liability. So this is going to tell you how much cash or how much capital you have available that is available to you, right? So it could be stuck in inventory, it could be cash, it could be, other current assets that are on your books, but you take that current assets minus your current liabilities and gives you your working capital number. And that tells you pretty much how long of runway that you have to keep operating your business without it really being a problem.
That's fantastic. What are some, like you mentioned timing earlier. I feel like timing timing inflows of cash versus the outflows can be one of the big ones that gets people stuck because they're like, I have all this money coming in, and I think it's very easy as an entrepreneur to sort of, you're already counting it, right? It's coming. I know I've got this house, it's under contract, whatever it might be. You're sort of assuming that money's, and then you're making plans with your expenditures kind of with that in mind, like you've got it, but you don't. And then something happens, it doesn't come in when you thought or whatever. But if you mistime that, it can be fatal, really, but it certainly can be very, very painful. Talk to me about that and how you work with your clients on matching up that timing, and trying to avoid some of these pitfalls.
Yeah, totally. So first off, a good forecast is critical in the real estate industry, right? And updated on a regular basis, a minimum weekly, but certainly monthly is almost a necessity so that and what is a forecast? People get scared of that terminology, but a forecast is simply just saying, hey, here's the revenue I expect. Here's the expenses I expect, which, by the way, guys, I'm going to give you a little secret. 80% of your expenses are the same expenses every single month. So it's not that complicated to forecast this out. We know what they are. It's the same subscription payment you paid last month, right? So most of your expenses are already squared away. And so a good forecast will tell you. But the other thing is, this industry is just that way. It's a industry of cash in, cash out in large lump sums, and it moves around quickly, especially when you go from doing 1 to 2 properties to 2 to 3 properties to 3 to 6 properties, and so on and so forth. And you get to a spot where you have all of this money. Just a perfect example. I deal with this every day. Hey, we paid $50,000 for construction on this property, and we need a construction draw. That process to do that is very easy when you have one property, right? You're on top of it. You know it. But when you have 20 and you're like, I got to ask for basically a draw request every day per property because I got a different property that's hit a different stage that I can get my draws. But yet your money's going out first, and then you're replenishing it with those draw requests. And so you have to have reserves. This is that 10% debt reserve account that I talk about, because if you don't have the reserves in place, you're always going to get yourself into a spot where cash flow is an issue. And it doesn't matter how big you are. Like, it doesn't. Cash flow. I was talking to a gentleman 2 weeks ago where 2 weeks prior to that, they had $1 million in their bank account, $1 million. They thought life was good. 2 weeks later, they had $200,000 in their bank account, and they had a lender pulling a $250,000 line of credit from them. they were in trouble. They had to go solve that problem. And it wasn't that big of an issue. They just had a bunch of money setting in deals that they needed to free up from those deals. And we did that and solved it and moved on. But when you take your eye off the ball and you don't have the reserves lined up, you can find out very quickly that reserves, even if you do, they can get washed up very quickly if you take your eye off the ball. So it's very, very important that you have that forecast, you have the reserves in line, but you also make sure that you have a dialed in process for if you're going to be flipping that many properties, if you're going to be running that large of a construction budget, that you're able to ensure that, hey, as soon as something's done and you're available, that draw request is available to be requested, or that draw is available to be requested, you do it and you have a process so that you can get that money back in and replenish it, because most of us are using operating capital to fund these construction loans until we get our draws, right? And then so we need that drawback to fund our operations, to do our expenses, to fund our human capital, our G&A, our advertising and marketing, all that good stuff.
I think those are all really great comments. There's number one, I think those ratios are super helpful. But yes, I love the concept of the reserves. And I agree. I think the timing of some of these things, and if you get off just a little bit, man, it can put you in that kind of, crisis mode. And and you pointed this out earlier, most people get into this business so that they can relieve themselves of those types of things. And so you don't want to put yourself in a cycle where you're constantly in survival mode and then, oh, everything's great. And then boom, you're back into survival mode and back out. That can be incredibly taxing. And I think it makes it a lot less fun, for sure. I mentioned, and I said taxes in a different context, but I think it's really important, and I would be remiss if we finish this conversation without touching on taxes. I know there's been some changes with some of the new tax laws that have gone into effect. How is that, if at all, impacting your clients? And anything that you think folks should know regarding kind of the taxes, which I imagine can be a pretty significant component of the overall expenses if not handled correctly.
Yeah, I mean, well, here's the thing. You get to this process, you go through the process, right? Hustle, secure, expand, invest. And you get to that, usually it's that expansion phase where taxes really start to nip at your side, right? And sure, when you're in the hustle and secure phase, you're making some money, but your tax rate is relatively low. Generally, if you're making less than a couple $100,000 a year, you're paying in the teens as far as your taxes. And in the grand scheme of thing, when the highest tax rate is 37%, paying 15% in taxes is a very, very manageable amount. And why that matters is because the more money you make, it is important that you focus more on paying less in taxes, because we live in a system that is marginal tax rates, right? Which means the last dollar you make is your most taxed dollar. But it also means the tax strategy that you employ attacks the most taxed dollar first, right? And so it's kind of a win-loss ratio there. And so what we talk about, one big beautiful bill, this is the one that Trump put in play. This is what most people have probably heard about. There's a lot of intricacies, but for real estate entrepreneurs, everybody loves what's called bonus depreciation and 100% bonus depreciation and cost segregation. And why I mentioned that we're in a world of marginal tax rates. Well, what that means when you buy a property, and let's just for simplicity say that property can give you a $10,000 deduction for buying that property. And that would be a low deduction for most properties, but let's just do it because the math is easy. Well, if you're at the 15% tax bracket rate, that saves you $1,500 in taxes, but you just bought this massive house. And you had all the risk and you had all this issue that, you got all the things that come along with buying a rental property, but yet you're only saving $1,500 in taxes. Well, let's take that at the 37% tax bracket. When you're in the 37% tax bracket, now you can take that $10,000 deduction, same deduction, same everything, same house, same walls, same color, nothing changes, but you save $3,700 in taxes, right? Because you're at the 37% tax bracket. And so the more you make, the more important it is for you to focus on tax strategy, because the bang for your buck gets to be significantly higher. And that's why you see so many people that are real estate entrepreneurs and they're looking to get, okay, how do I get a $100,000 deduction off of buying this $400,000 piece of real estate? We see people all the time where their tax savings literally is more than they have cash invested in the property because their tax rate is so high. So, it saves them $37,000 in taxes, but because they were able to fix the property up and they were able to burr the property, they only ended up with $20,000 in cash in the property. Well, guess what? You just netted 30 or 17,000 bucks in your pocket by owning the real estate versus selling it. And I think that's one of the things that the one big beautiful bill and bonus depreciation and combining that with cost segregation, which is probably above this conversation at this point in time, but that's the magic of real estate right now, is that you can buy these investment properties, and the wealthier you are, the more money that you make, the more bang for your buck you get. And the better the tax returns are on that. And then you get all the other returns, principal pay down, appreciation, maybe a little cash flow, although cash flow is at a premium right now, those kind of things. So yeah, we see that. And oh my gosh, we could do another 2 hours on just tax strategies with real estate entrepreneurs, and we wouldn't even cover the surface. There's so much you can do with these assets, and timing of the depreciation and timing of the expenses. And it gets me fired up to be in this industry. It's one of the things I love about it.
Being that fired up on taxes and things like that, that's not your normal person. So, I think you're in the right seat. And at the end of the day, and I agree with you, I mean, there is so much, and listen, I think most people probably like me, my eyes start to glaze over when you start getting into the weeds on taxes. But that's why, again, I think you need a professional, and that's why I think, people should really consider, bringing in someone like yourself who, can do that for them, and they don't have to necessarily sit there and learn it all, because it's a lot. And most people have many other things to do with their time. This has been an amazing conversation. I think we're kind of getting to the point of wrapping it up, but I thought maybe it would be a good opportunity if you have any, stories or anecdotes of some things that you've done for some of your clients that have made an outsized impact on their ability to grow and maintain the strength of their business. I'm sure you have 1,000 of these that you can think of, but I'd love for you to share, a real world example of something you've been able to do with one of your clients that turned out to be really impactful.
Talk to you about this one. So we've got a client that's, they typically make between $1 million and $2 million a year, just to kind of depending on where they're at. But their goal this year was to establish another level of liquidity, right? And again, as you've heard us talk, we talk about, as you're increasing your expenses, increase your reserves. And so they're looking to grow their business and they want to increase their reserves, but taxes are a big part of that, right? And when you make a couple $1 million a year, the tax guy wants about 700-800 grand of it, right? And so, it's our job to make sure that they stay as liquid as possible. And they could have went out and bought a bunch of real estate, and that would have worked out for them, except for they wouldn't have been super liquid. They would have had all their money trapped in real estate, and maybe would not have been the best thing. So we spent, I don't know, 3 or 4 months looking for different options for them, and found an investment for them to where they were able to actually save more money by making that investment in taxes than the investment actually cost them. And it was by about 2.5 times. So they saved, let's just say, $250,000 on a $100,000 investment that they were super, super excited about. And so that's a really, really good win for us. And those numbers were a little bit bigger than that, but just for simplicity purposes. And they were really excited about that. And what that does is it allows them to do what they're doing now, which is the most important part, because we say that tax strategy and tax savings is supposed to fund your wealth. not your lifestyle. So like, we don't want you to go take that savings and buy a Ferrari. That's not what it's for. We want you to take that savings and reinvest. And now he's hiring another person. He's looking at buying a couple additional properties. He's got himself into a spot where he's got the liquidity so that he can continue to grow his business. And, that's just one of the many stories that we see on a daily basis, right? Like that's kind of where we get to, and where we get to support people is where they at in their life, what do they want to do, and then how do we combine those custom strategies with with where they're at, so that we can get them that direction, because everybody's different, right? Somebody may want to be worth $100 million. Next person wants to be worth $2 million, and their path to get there is two very, very different things. And so to employ the same strategies for everybody, we would be doing a disservice. So we certainly take that custom approach, and that's a good example of it.
I think we did a good job of laying it out, kind of what it is you do, the value you can bring to your clients, and how important it is. So I appreciate you sharing those thoughts with me and with our audience. And I guess the last thing would just be, how do people get in touch with you? And we'll make sure that we include all this in the show notes, and certainly happy to make any connections that we can. But how do people get in touch with you if they want to, learn a little bit more about what you're doing and see if there's a fit?
Yeah, totally. BECCFO.com, BECCFO.com is our website. You can follow me on social media. I'm on Facebook all the time, trying to give as much free advice as I possibly can. But if you go to Beck CFO, there's a ton of resources on there. At a minimum, check those out. If you'd like to schedule a call with us, there's a Let's Talk button in the top right-hand corner of the website, and you can fill out the form. Give us a little bit more information about you, and we'll get a meeting scheduled and see if we can help you.
Awesome. Well, listen, I think it's amazing. I know a lot of people that work with you that have been incredibly happy, and I know you've been super valuable to their businesses. So really appreciate you sharing some of your expertise with us today, and I look forward to seeing you at the next Collective Genius event here soon.
Sounds great. Thanks, James. Appreciate it.